I now hand the conference over to Mr. Ankur Maheshwari from Firstsource Solutions. Thank you, and over to you, sir.
Thank you, Zed, and welcome everyone, and thank you for joining us for the quarter ended December 31st, 2020 earnings call for Firstsource. To take us through the results and to answer your queries, we have with us today Mr. Vipul Khanna, our MD and CEO, and Mr. Dinesh Jain, our CFO. We will be starting this call with a brief presentation providing an overview of the company's performance, followed by a Q&A session. Do note that the results, the fact sheet, and the presentation have been emailed to you, and you can also view them on our website, www.firstsource.com. Before we begin the call, please note that some of the matters we'll discuss on this call, including our business outlook, are forward-looking and as such are subject to known and unknown risks. These uncertainties and risks are included but not limited to what we have mentioned in our prospectus filed with SEBI and subsequent annual reports that are available on our website. With that said, I now turn the call over to Mr. Vipul Khanna to begin the proceedings. Okay?
All right. Thanks, Ankur. Good morning, everyone, from a cold San Francisco evening. Thank you for joining us today. Hope everyone continues to keep good health as we enter, hopefully, the home stretch of this long COVID fight. Let me start by giving a quick overview of our Q3 performance. We had another strong quarter with revenue growth better than expectations. Revenues grew 23.8% year-on-year in constant currency, 29.6 in rupees, and came in at 13,632 million rupees or $184.8 million. Adjusting for the acquisition of Patient Matters, organic growth in constant currency was 22.9% year-on-year. I will discuss the importance of this acquisition in a few minutes. The EPS for third quarter came in at rupees 1.72 per share compared to rupees 1.29 per share last year for the same period. The demand environment has been good, and our teams have stepped up to execute strongly to take advantage of it. Revenue growth in CMT segment was driven by strong demand from existing clients and ramp-up of recent wins. Incidentally, this segment grew the most sequentially. BFS witnessed continued demand, particularly in our mortgage unit, and our UK retail banking business also saw a sequential recovery. In healthcare, especially in health plan and health services segment, recent wins fueled the sequential growth in revenue. Sales momentum continued. We added 18 new clients this quarter, taking the tally to 43 new clients year to date. This does not include the clients added from the acquisition of Patient Matters. Our intelligent automation practice is making meaningful strides across verticals, including a significant win in the bond digital segment. Overall, I'm pleased with the way our overall strategy is playing out and the execution rhythm of our organization. Despite the logistical challenge of a distributed operation, the team is doing a phenomenal job in ensuring both client and employee satisfaction while delivering strong growth. In the past, I've spoken of the three tenets of our ambition to build sustainable, high-quality growth platform. These three tenets are: 1, for the three core industries we serve, sharp focus on specific segments where we have or can attain market leadership. 2, modernizing our offerings, underpinning them with our digital-first, digital now approach. And 3, a scalable and an agile organization with the right leadership and skills to drive our growth ambition. We're making good progress against each of these three dimensions. Let me give you a few additional data points on that. In the last 12 to 18 months, I've spoken about our aspiration of expanding into the new age sector and in particular amongst the bond digital companies. In the last 9 months, we've added 9 clients, new clients which are in the fintech or the tech industry. At the same time, we are solidifying our domain expertise in our chosen segments. The addition of Patient Matters in our portfolio not only enhances our scale in the healthcare industry, but also provides niche platform-based capabilities. Second, our digital office, as we call it, has turned one last week. In these last 12 months, we've retooled most of our existing capabilities, making them more agile and market ready. The solutions for almost all deals that we compete for now leverage our new tools and platforms. And I'll talk a little bit more when we discuss the segment results. The third key element is to scale our organization. In the last three quarters, we added nearly 5,300 people organically. This already exceeds the net addition of any fiscal year in the history of the company. And what's exciting is that we were able to pull this off remotely. I'm very impressed by the energy, focus, and collaboration across our team globally to make this possible. Let me talk a little bit about the Patient Matter acquisition. As we have said in the previous quarters, we are pursuing a systematic inorganic growth strategy for growth adjacencies to our existing offerings. During this quarter, we completed the acquisition of Patient Matters. Patient Matters is a national revenue cycle service provider that provides two services: patient advocacy services and a front-end revenue cycle management SaaS to address patient responsibility and self-pay segments. This acquisition complements Firstsource provider business on two dimensions. One, it strengthens our geographic presence in large markets like Texas and New York. And two, it adds new capabilities of pre-authorization and patient bill estimation at the front end of the RCM cycle, strengthening our core offerings of self-payment and uncompensated care. This acquisition cost us $13 million, 100% funded in cash, and the integration process is underway. We are focused on growth synergies as we prepare for the hospital and the physician segment to return to normalcy. We have consolidated our healthcare provider brands Medisys and Patient Matters under the Firstsource provider business to reflect the close alignment with our core brand and leveraging our position as a global BPM leader. Let me now move into our key industry performances. Our banking and financial services segment grew 56.5% year-on-year, 49.9% in constant currency terms. Growth was driven by volume recovery in UK retail banking and continued volume and business growth in mortgage. Collections had a somewhat softer quarter due to seasonality. In this quarter, we added 10 new clients, including one fintech. The deal momentum continues to remain quite strong amongst both new and existing clients. Digital collections product continues to gain market share. The mortgage industry continues to benefit from a low interest rate environment, and even today, a large portion of existing mortgages would benefit from refinancing. New home sales are at record high, driven by people moving, low interest rates, and higher disposable surplus with consumers. If interest rates remain low as widely expected, mortgage volume should stay strong. We continue to focus on building the mortgaging services portfolio and are witnessing good momentum of new wins here. This helps diversify the overall mortgage portfolio. Volumes are recovering in the UK retail banking sector. We are seeing good traction with our existing customers and a healthy pipeline as UK banks gear up for post-Brexit and a post-pandemic economic environment. Overall, trends for this segment look positive. Healthcare increased 0.8% year-on-year, while declining 3% in constant currency. Organically, the segment declined 2% year-on-year and 5.7% in constant currency. Volumes for this industry remain flat or lower than last year as US deals with the second wave of COVID-19, and most states are grappling with a higher Medicaid cost load. Despite these trends, we are encouraged by the progress in our portfolio. We've been systematically enhancing and productizing our go-to-market offerings over this past year, and this is being received positively in the market. Health plan and healthcare services in particular has shown good momentum with a strong pipeline and a number of strategic deal wins. In the third quarter, we won a 5-year deal to manage digital intake of claims, etc. for a top 5 health plan in the US. We continue to make steady inroads in the telehealth market, adding one new client this quarter. In the provider business, we expect a return to growth in the coming quarters. As you know, the last couple of quarters have been soft for the industry. The addition of patient matters capability will help us strengthening our patient responsibility value chain and help us differentiate in the marketplace. In this quarter, we added 3 new clients for the provider business and all of them on our platform-based offering. I'm confident that the healthcare sector will see a rebound in growth during the next fiscal year. Let's talk a little bit about comms, media, and tech, the CMT segment. This segment grew 21.3% year-on-year and 15.1% in constant currency. We've seen good growth with our top customer. Their business has recovered nicely and growing, especially the OTT or the streaming business. This has driven volume recovery and new work streams for us. We've achieved nearly 50% work from home capacity for the UK operation supporting this largest customer, minimizing the impact of the second wave which UK is grappling with now. India operations remain very stable over the last 2 quarters now. Other media clients are also trending better than their pre-COVID levels, led by strong volumes. We added an international weekly publication for high net worth clientele to our clients this quarter. We will manage this client's digital customer engagement journey based on our new age contact center offering for the UK and US user base. The media and tech portion of CMT is a key and a new area of investment, especially in the US, and is beginning to take shape. We added 2 new clients this quarter, including an e-commerce giant and one of the largest bond digital process automation platforms. While revenue contribution is still small, I'm pleased with the progress we're making in this new market segment. And lastly, the diverse industries grew 5.1% year-on-year and were flat in constant currency. Finally, a look at our outlook for FY 2021. Considering the momentum that we are witnessing across our businesses, we are further revising our guidance upwards. Our fiscal 21 revenue now is expected to grow between 16 to 17% in constant currency. This includes 0.9% from the Patient Matters acquisition. On the operating margin, we expect a range of 11.25 to 11.5% for the current fiscal. This factors in promotions and increments effective 1st January. With this, let me turn the call over to Dinesh to cover the financial details of the quarter. Dinesh?
Thank you. Thank you, Vipul, and good morning, everyone. Let me take you through the financial performance highlight for Q3 FY21. Revenue came in at rupees 1,365.2 crore or $184.8 million. This implies a year-on-year growth of a 23.8% in constant currency and 29.6% in rupee terms. On the margin front, operating margin came in at rupees 159 crore or 11.6% of the revenue. Profit after tax came in at rupees 121 crore or 8.9% of the revenue. I'm pleased to inform that board has also approved an interim dividend of rupees 3 per share. This will result into a payout of rupees 208.7 crores. We have generated 645.3 crore cash from operation and our FCF came in at 535.5 crore. This is after adjusting for capex of 109.8 crore, which was, and then the Q3 it was almost a 63 crore, which is the highest in some of the quarters. We also lucky in some form where one of the largest customer wanted to give advance for future receivables, and we happily taken those one, and which was about 180 crore. And this also result into a good interest arbitrage to us because we also still have a debt in the balance sheet. Capex for the quarter was slightly higher as I spoke. This was for the 2 new centers which we have set up in one in Mumbai and another in the US. Our DSO declined sequentially from 54 to 53 days, including unbilled. This is driven by timely collection of receivables and also billing on time. Our closing cash balance as of December 31st was approximately 301.3 crore after repaying 101 crore of our working capital borrowing and also utilizing 95 crore for acquiring Patient Matters. Of the $13 million which we have paid for Patient Matters, we have allocated $1.5 million, 10.9 crore to the fair value of the identified net assets, and balance of 11.5 million or 84 crore has been allocated to goodwill on a provisional basis. The net debt stands at 204 crore versus the 391 crore in the Q2. And in the dollar term, we have a net debt of $27.9 million against $53 million in Q2. During the quarter, also looking at low interest rate environment, we have converted 15 million pound working capitals to a long-term debt, which will have a 2-year period. Last 3 quarters, we have brought down our net debt by 448.5 crore, or approximately $58 million. Tax rate for the Q3 was 18%, but we expect that it should be during the range between 16 to 18% for the year. On the forex hedging, we have coverage of pound of 63 million for the next 3 years, with the rates ranging between 103 to 119 to the pound. And the dollar coverage is $90.5 million with average rate of 76.57. I'm pleased with our business performing, and various constituents of the business are coming together to drive holistic growth. With this, we can open the call for questions.
Thank you very much, Mr. Jain. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, please press star and 1. The first question is from the line of Manik Taneja from JM Financial. Please go ahead.
Thank you for the opportunity and congratulations to the team for very solid execution. I had a couple of questions before I get back into the queue. Number one question is on your guidance. Given the fact that typically 4Q is broadly in line with 3Q, how should we be thinking about the sharp Q-on-Q fall in growth rate that the guidance seems to suggest? While I understand that it's coming on the back of a very solid 2Q and 3Q performance. And the second question was to get some quantitative sense on the contribution of the mortgage business in the BFSI revenue performance this quarter. Thank you.
All right. Thanks, Manik. So look, we had obviously very strong sequential growth in Q3, primarily driven by a couple of factors. CMT had good volume recovery in Q3. Mortgage obviously continued to grow strongly, but we do expect that the growth rate will start to kind of moderate a little bit, right? While the business will still grow, maybe not just at the same pace. So we kind of tried to model that in as we start this new year in the US. Hospital segment, right? It's still evolving, right? We were looking at good traction sort of as the Q3 started, but with the second surge and Thanksgiving surge, it's kind of gone again into a little bit of degrowth zone. So you'll see sort of how Q4 plays out on the hospital side of it. So overall, when we model all this in, we felt that 16 to 17% for the full year reflects a good estimate of where we think the year will end at this point in time, building on Q3 and seeing some of the factors that I mentioned for the Q4 development. Your second question was share of mortgage?
Yes, that's correct, Vipul.
Yeah. So look, mortgage continued to be a strong performer. Right. The revenues this quarter for mortgage jumped to about 55 to 56 million. We continued to gain good market share in terms of new wins as well as volume growth. But at the same time, UK retail banking, which is the other large component of our BFS business, that has started to show very good traction. We've had a decent amount of win and a strong pipeline as we execute this quarter, which we are excited about. And collections, if I could take a moment to comment on collections. When COVID started, there was expectation that the credit defaults will increase in the US. But as the government has stepped in, as the stimulus has stepped in, as moratorium stepped in, that default scenario has got pushed out further and further and further, right? So to that extent, collections had somewhat of, from what we started the year, somewhat lesser growth, more muted growth than we expected. But overall, I think Q4 typically tends to be a stronger quarter. We'll see better results from them, and then we'll see how the macro events play out in the next year for collection.
Sure. Thank you. All the best for the future.
Thank you.
Thank you. The next question is from the line of Mohit Jain from Anand Rathi. Please go ahead.
Hi, Vipul. First for you, like in healthcare vertical, what kind of, first is on the large deal that you have signed. So if you could quantify some numbers there and how healthcare vertical recovery is expected next year, given that you're talking about some moderation in the mortgage business. That's one. And second, on the offshore side of it, we have seen some improvement, but as you reduce contact center and move more towards healthcare, should we expect offshore overall and therefore margins to have a positive bias going ahead?
Sure. So look, for the healthcare segment, there are two segments, right? There is the health plan and health services, and there is the provider. In the health plan, health services, HPHS, we've been working hard for the last almost 12 months now. We build a team focused on sort of our strengths, and our digital intake platform is being received very good in the market. And the new win that I mentioned is for the digital intake for one of the top 5 health plans. And this is a new relationship that we've opened up, and it's a giant health plan. We hope that we can continue to kind of build on this relationship. It's a 5-year contract, and this for now we have quantified it about a 22 million TCV on a 5-year basis. We have other wins as well in HPHS and a strong pipeline. So I'm expecting that Q4 onwards, as well as going into next year, HPHS will perform strongly, and we'll start to see meaningful revenue growth started to come from there. Okay. Although I would just add one little qualifier that typically Q3 or the December quarter for HPHS tends to be higher because of the open enrollment season in the US, and then we see some seasonal downtick in Q4. That's just the peak up of Q3, which does not sustain in Q4. But structurally, our pipeline and our products are developing well, and from the historical numbers, you'll see meaningful growth, going forward on HPHS. On offshore, yes, given a lot of our growth this quarter has been driven by mortgage, so we've seen continued uptake of offshore. As I mentioned earlier, given the value proposition that we offer of a global delivery, right? We don't necessarily go to the client with one or the other, right? It's a proposition of a layer onshore and where required a layer offshore. So it's not a conscious strategy by design to go and say we want more offshore heavy business here. It all depends on sort of what the opportunities and what the client's context is. So as a margin lever, it's not something we are consciously driving, but overall on the margins, you've seen we've kind of delivered on what we had forecast. And even this quarter, we had about, I think, a 40 basis point or year-on-year 40 basis point improvement in our operating margins. So we kind of within the range of margin that we had forecast on top of the strong growth.
Right. What I was asking was last year when you took charge, that time there was this talk of investment into the growth, and therefore we had this 150 or 200 basis point additional investment requirement. Which was brought in, and I was hoping that in 22 that may sort of start eroding, given that your growth is sort of back and the investments I'm hoping would have been complete. So your margin should have some tailwind ahead. Is that a fair assessment?
So let me answer it this way, right? That there was a bump of our investment we made in our SGA. Now, as we go deeper into the segments, we continue to make investments, maybe now at an account level or trying to open new offerings. Like in mortgage, we are evaluating 1 or 2 adjacencies into the closure and the due diligence segments, right? So investments for building, not at that bumpy level that you saw in 20, we'll see continued investment to kind of fuel the growth. From a margin standpoint, directionally, you are right. We are we are aspiring that through operational excellence and as our service mix changes a little bit, there's a little bit more higher margin digital options come into play. We should see tick up in our margins over the next couple of years. But keep in mind, our primary sort of strategy at this point is to drive top quartile growth with continued investment focus for them.
Right. And the second for Dinesh, sir. So your debt was going down, which is good to see, but current liabilities saw some jump ex customer advances. Is there any other liability which has gone up in this particular quarter? And last is on tax rate for FY22. Like, when do you expect tax rates to be more in sync with the rest of the industry?
Yeah, so the current liability normally, other than one advance which is now taken out, so is only on account of the employees' payments. What happens? You have a payment cycles in US and UK, so you have sometimes the lesser number of days get paid, so you have to accrue those liabilities. So that is one component, as well as the UK have given a VAT liability can be postponed for 12 months. So you opted for that. So your VAT liability will in future will get paid in a proportionate basis. These are two components which are added to the current liability. As far as the tax rate is concerned, I think this going forward it has to be slightly increased. But as you know, onshore still the US and UK rates are around 19%. Until the time US government does not come back and change the tax rate, I think should range around, I'll say, between 18 to 20% for at least next 1-2 years. It should not drastically change. India side also, again, I think the new SEZ will not come. So probably next 2-3 years, still we have a good window to have a benefit of SEZ, which will taper down in the future. But I see at least the next 2-3 years, we should be around 18-20%.
Perfect, sir. Thank you very much. That's all from my side.
Thank you very much. Next question is from the line of Rahul Jain from Dolat Capital. Please go ahead.
Yeah, hi. Congratulations on strong execution. Firstly, on this acquisition, I would just like to understand, how we plan to improve per hospital kind of revenue for this business, and what is the cross-sell opportunity that we see in general, which could be, could be done in an immediate future.
Okay, great. Hi Rahul, thanks for the wishes. So this acquisition, as I said, is complementary to us in two. We see cross-sell opportunities both ways. Their patient advocacy business is similar to what we call eligibility services, except they operate in states like Texas and New York and Arkansas, where we're not very big, right? So it opens up new client segments for us, and we can take our payments offering and our other automation services offerings to their clients, right? So that's cross-sell into their client base. Second, they have a front-end SaaS which does upfront patient estimation and pre-procedure payments, right? Historically, we have done post-procedure payments and collections, right? That's been our play on the payment side. These guys are coming in at the front end on the prepay side of it. So I think with this, it allows us to expand our platform and start to kind of go with the vision of end-to-end payments of the self-pay portion of the patient expenses. So there is the insurance portion, right, which is collected either from commercial or Medicaid, but the self-pay portion, which is mine as a patient share, collecting that, and that's about a big chunk of the debt for the hospital. Collecting that proposition is the one which expands for us, and I think we can take it to our existing clients, and we'll take to their clients in an expanded form. So those are the two cross-sell or the revenue synergies we see with them.
Yeah. So, in any sense of quantification of changing addressable opportunity size, because I think our base of hospital is much larger. So taking their capability into our set of customer and other way around, do you think this total addressable opportunity within the current client pool itself goes up significantly higher?
It does. Absolutely, it does. I don't have the numbers handy in terms of the addressable market on what it does. We'll get back to you. But in general, if you ask me, these guys, Patient Matters pre-acquisition is in about a $15-16 million annual run rate. And we have a base case or a business case to drive up in the next 2 to 3 years revenue synergies from them at a reasonably sort of aggressive clip, right? That's the synergy pool, right? Whether it's selling to their client base or ours. But we expect this revenue to go pretty aggressively in the next 2 or 3 years as we integrate and go out to their client base and vice versa.
Okay. Thank you. Just one more, if I may. Despite the significant growth leverage we have right now, we have not seen this translating into profitability. And of course, we are investing in the areas which you've been articulating for some time. My worry is more from the point of view that how we would ensure that these level of profitability can be protected if the growth slows down eventually.
Okay. So your question is, how will we protect the margins?
So for example, as you guys are portraying that this is the level of profitability, beyond which you are mostly investing back for the channels you want to, and so as long as we have such a high growth, flattish profitability is also a very strong sign because you end up growing big on EBIT as well. But when the reverse of the cycle happens, when your growth comes off, but costs have their own inflation involved from the supply side factor also, how you protect this margin at this level also?
Sure. Let me give you two colors, right? First of all, for sort of how this year's margins are playing out, right? First of all, you've seen the mortgage business has grown very aggressively, and we had to invest to harvest that growth, right? So things like hiring ahead of time, investing in longer training cycles to kind of make sure that semi-finished talent we can bring up to speed before we put them up to client processes and to billability. Because we want to make sure when clients come to us and when they have higher needs, we are there to meet that, right? So we continue to be the first port of call for them, right? That's been our sort of strategy. So to that extent, we've invested at the account level, at the talent level, to kind of make sure we harvest this growth. And I'm convinced that this adds up to deeper and healthier relationships in the long term. The second aspect is that our provider business is largely outcome driven. And with muted volumes, it impacts margins from fixed and semi-fixed costs. As volumes return, right, in the next fiscal, and we add more clients to this platform, we will see the margins for this business kind of rebound back strongly. So this has been sort of a couple of the factors which have played on the margins for this year, right? Some to feed the growth and some to kind of deal with sort of the volume volatility in the provider business. At the overall level, the businesses that we've added, the wins that we've added, whether it's in mortgage or HPHS, or in continued the new wins in CMT, these are high quality, above threshold margin deals that we have done. So I'm confident that while we'll continue to drive top quartile industry growth, we can see year-on-year sort of modest increases to our operating margins from the current level to OPEX and higher margin mix of our service.
Okay, so you expect this as a gradual uptake over a period of time?
Yes.
Okay, and in a way, we can also read if the mortgage growth opportunity slows down whenever it happens, and provider also picks up, this itself should have a good outcome on reported profitability.
For sure on provider, because that's the nature of the business, right? It's completely, or big chunk is outcome driven, right? And mortgage, as I said, we've been building, obviously origination has been a strong part, but we have been building our servicing portfolio as much, and a good chunk of our recent wins have been in the servicing business, which is steady business with decent margins, and that will continue through. So yeah, the drift of your question is correct, or your assumption is correct, the drift of your question is correct.
Fair enough. Thanks for the clarification.
Thank you very much. Next question is from the line of Dipesh Mehta from Emkay Global. Please go ahead.
Thanks for the opportunity and congrats on very strong execution. First question is just try to understand if you can provide some outlook on CMT business outside of the top line. How you expect it to play out? You gave some new client addition and acquisition in fintech and other new age technology, but if you can provide some perspective about how you expect it to play out over next couple of years. Second is about UK BFS. Seeing some recovery this quarter, but how you expect that recovery to sustain and accelerate, or you think it reach to some kind of plateauing once we exit this year? Second question is about the top client. Now we have seen strong recovery this quarter. How you expect that recovery to play out? You expect this momentum to sustain, or it is likely to see some softness? And related question is about the advance receipt. I just want to understand nature of this advance receipt in terms of whether it is a normal course of business or it is some specific event happening and that's why we receive this advance. Thank you.
Okay, great. Thanks, Dipesh. First question, CMT business outside of Sky. So outside of Sky, our focus has been, we have a good niche developing for digital media, right? So I talked about the win with a global leading publication to manage their customer experience across channels. And on the strength of that win and the capability that we have, we are expecting good sort of outcomes in our pipeline in this quarter as well. So digital media is one area of growth. The second area of growth is sort of the technology segment, right? The bond digital segment that I've been talking about. So there we've been working hard. Obviously we started afresh on that. So it will take time to build revenue, but we've had good wins. We are zeroing in on sort of what the value proposition there will be. And I expect that in FY22 we'll continue to make good new account wins in the bond digital or the tech segment, whether it's fintech or consumer tech or enterprise tech, right? Some of it will have to play out. Meaningful revenue I expect will start to come towards the fag end of FY22 or into FY23, unless we kind of have some early and substantial wins. And this incidentally is also an area of inorganic focus for us to kind of get more momentum into our efforts for the bond digital segment. Besides that, I think the US portion of our the C portion of our CMT, right, the comms portion, that also saw good growth in Q3, which we expect will sustain through from here onwards. So that's kind of color on CMT outside of our largest customer. UK BFS, we are amongst the leaders. We fought hard, and I think we're starting to see some good wins come out on our existing clients there. Our overall sense is that the UK banking sector is preparing for continued low interest rate regime, right? And post-pandemic, whatever the fallout on the economy would be. So there is a good momentum of conversations among the UK banks for looking at their cost base. And we're starting to see those opportunities line up or come up to fore, which were not there in the last 2 years. And we are working hard to make sure we win our fair share of their efforts to find cost benefits, as well as transformation to their portfolio of businesses, as they don't want to lose the tactical gains on digital. They want to make it more permanent gains in digital. There are opportunities for transformation of individual business lines. So I think the bottom line there is, I think the momentum there will be sustained in the UK BFS segment. Sky, last question, whether the momentum will sustain. Clearly, we have worked very hard and be very agile and flexible to their needs. This is well recognized by the client. We continue to be their preeminent supplier, and I think we've gained market share compared to some of their other smaller partners. What we are now back is sort of to the pre-COVID levels. Their business is at at pre-COVID levels, and we are slightly ahead of that from a pre-COVID level of our share of the spend that they have with us. I expect that this will sustain, and as we get into the summer and as the world finds its new ways of sort of evolving, as they kind of figure their way out, we are kind of working lockstep and battle with them under their new leadership as they lay out their growth strategy. We want to play an integral part of that. So we definitely expect this to be sustained and hopefully grow modestly from this level, given we are such a big part of their momentum, a big part of their portfolio. Lastly, the advance receipt. It's a fairly widely used technique of when interest rates regimes are low, that customers want to do advance payments of invoices to gain some interest rates. And as Dinesh said, it is still beneficial to us. So we kind of wanted to do this as a win-win for our largest client as well as for us. But I've seen this used fairly regularly in interest rates regime where treasuries of our clients want to get some financial advantage by paying ahead of time.
Understand.
Anything to add to that last comment?
No, I think that's the perfect. I think that is what the reason they have reached out to us and say whether we are happy to take an advance, and this will be adjusted against the invoices between March to June. So yeah, it is very clear understanding that it will be future receivables, and yeah, absolutely for their treasury purposes this has been done.
Understand. Last question is about the development center which we added. We added almost 6 in last 2-3 quarters. Now, considering work from home as well as, I understand because of mortgage business, we might require increase, but your OPEX seems to flat. If I look, let's say Q2 to Q3, I just want to understand thinking on this part. When you have work from home option available, then why to add center? And if you are adding, why it is not getting reflected into OPEX? Thank you.
Sure. Dinesh, you want to start on that?
Yeah. So OPEX cost, if you see, most of the centers are open. It's not that due to work from home, those are not there. Because for some of the customers, we are still working from offices, and due to the social distancing, the number of seats used is lesser. As far as the new centers are concerned, those have started into this quarter, so there are slight increase of cost must have happened. But in a percentage term to the revenue, there is no meaningful increase. The reason being that all of the centers are operating and the same operating costs, including rentals and all getting incurred. Future going, when the people will start coming back to the offices, again, we don't see that we have to add a meaningful capacity. We may have to add few capacities around. But again, there are some of the costs which is, as of today, is excess for us, for example, on a technology or, for example, on the transport to bring the people to the offices, which will also come down once everybody will in the office and all public transport will open. So I think going forward, when everybody will work from home, will back to offices, we don't see it's going to be a meaningful change into the operating expenses per se. Hope that answers your question.
No, understand. So my limited question was, if there's work from home, any benefit we envisage, because now even top client gave some permission for us to work from home.
Which is the additional one. I think you see in the UK COVID situation, the people who are not able to come to the offices, they have given a work from home and the extra one. But we have a sufficient capacity. So once they will come back, probably will run at 95-98% capacity, which is as of today, say 50%, the reason being social distancing. And these businesses which we are getting is basically to their growth, which we already have a seat capacities available. We may add few more centers, there is no doubt on that. But it's not going to be that the huge additions we need to do.
So we are right now, overall at a global level, about 40%, slightly south of 40% working from office, right, as some of the folks have started to come in. But obviously, as we've added far more business, we obviously have to start preparing for that capacity for eventual, even if it's not 100%, but partial return to work. So we're starting to prepare for some of that request, right, or when the transition happens back to office in sort of right earnest.
Thank you.
Yeah.
Thank you very much. The next question is from the line of Srijit Aji from Carnelian Capital. Please go ahead.
Good morning, sir, and thank you for taking the question. And congratulations on very strong growth in this quarter. So most of my questions have been answered. Just had one broad question. So in the revenue by service line that we have defined in our fact sheet, the platforms service line has basically seen a degrowth over the last quarter, while it was seeing an uptrend over the previous 2 quarters. So just wanted to understand what is the reason for that.
Sure. No, thanks for picking it up. Sorry, can you hear me okay, Shijit?
Yeah, sure.
Right. So look, this is a focus area, right? We continue to work on building platforms, and even because it's a better way of doing things, even go to our existing clients and convert them from the traditional way of doing to the new platform way, right? And that's the transition that we were working on. Specifically this quarter, the decline in this service line was primarily from a short-term project that we had finished, and that had the impact on revenue. But directionally, in terms of our wins that we saw in this quarter, in Q3, as well as the pipeline, the share of digital continues to rise from what it was a year ago. But this is more a quarterly aberration from a seasonal project or a short-term project.
Okay, perfect. So from next quarter onwards, you see this again picking up and growing as we go forward.
Correct.
Okay, great, sir. Great. Thank you so much.
Thank you.
Thank you. Next question is from the line of Shraddha from AMSEC. Please go ahead.
Yeah, hi. Good morning to the management team, and congratulations on a great set of numbers. Two questions, Vipul. Firstly, we've seen a meaningful increase in our offshore revenue mix, and despite that, EBITDA margins have declined. I'm not talking about EBIT margins, but EBITDA margins have declined. So your comments there would be helpful.
Sure. Hi, Shraddha. So on the margins, right, the earlier comment I had made that we're not consciously going to our clients with one or the other, right? We have a global delivery proposition that we're taking. From a margin impact standpoint, as I mentioned earlier, the growth that we have seen in a mortgage, the aggressive growth or servicing that faster growth, it has taken some additional investment from us, right? We've had to hire people ahead of time. Obviously, salaries for certain high skill segments are high, and two, training cycles are longer, right? Even from the fact that because we are in a distributed operation, managing the logistics of getting equipment to everybody's home, getting them started, etc., that impacts somewhat the time to build, right? So those are some sort of executional reasons on why we have focused on pursuing the growth, not letting go of the opportunities, even though it has meant additional sort of effort and additional cost from our side to harness that growth. And then the second reason was that the provider muted growth impacts margins disproportionately because they're an outcome-based service, right? It's a completely onshore-based business, 100% onshore-based business, outcome-based. When the volumes return, cost base kind of remaining the same, we'll see a better impact on the margins. But it kind of hurts us on the reverse when the volumes decline. Those are the two primary reasons why we've seen margins flattish despite some of the positive levers of growth and offshore coming there.
Okay. And just a follow-up to this, healthcare, the segmental margins which we disclosed, healthcare margins have also come off 350 basis on a sequential basis. So it's more to do with consolidation of patient matters, or is it because of the outcome-based revenue model that we follow in this space?
I'm drawing a blank on that. Ankur, can you answer that?
Sure. So there will be some element of patient acquisition as well on a sequential basis. But having said that, the margin softness is largely attributed to the revenue softness in the provider segment. As that normalizes, you should see the margin come back as well.
Right, sure. That's helpful. And just one last bit from me, because you did mention that you added a large e-commerce giant as one of your tech clients in this quarter. So what is the kind of work which we will be providing to the same account?
Yeah, it's a small win, right? Our intention was more to kind of open up the relationship, open up the MSA, right, and start to work through. So it's more like this is on merchant acquisition that we started work for them. Again, small scope project, more to open the innings with them and then work our way through their organization. But it's merchant acquisition.
Sure. So the ticket size would be relatively quite low to start with.
Yeah. fairly insignificant.
Yeah. Okay. Yeah. That's it from me. Thank you.
Thank you very much. Next question is from the line of Manoj Baheti from Carnelian Capital. Please go ahead.
Hi. Hi. Good morning, Vipul. Good morning, Dinesh. In fact, good evening, Vipul. I believe you must be from US right now. Must be taking this call from US. Hello.
I mean,
Yeah, we can.
Yeah. So I have if you can elaborate a bit on your digital now strategy. In fact, I will break this question into three parts. First one is that what kind of digital budget you are putting for next 2-3 years. Secondly, just wanted to understand when you are moving digital, whether it will be like in-house capability or it will be a collaboration with other IT majors. And lastly, just wanted to understand that what kind of disruption you see to your legacy business on account of this digital migration. Though digital brings its own set of opportunity, but it can also bring a kind of disruption risk to your legacy business. So on these three parameters, if you can give your views. Thanks.
Sure. So look, our strategy on in-house versus partnerships, it's absolutely blended. For product companies, either the giants like AWS Connect or the automation platforms like UiPath and a host of new emerging either specific use case players on AI or chatbots, etc. We will partner because they bring the product and we will take that product and embed that into our solution, and our value is to take that product, deploy it in the client context so that we can drive the benefit specific to the client's needs for that process, for that business unit, for that client segment, etc. Right? Second, there are a number of tools or platforms that we're developing in-house as well because they are core to our process. We understand those processes and it's about codifying that into our platform. So it's a blended strategy for external products and in-house products. As far as implementing and configuring those products is concerned, largely it's in-house, right? Prashant Chanta joined as CTO several months ago. He's been building up the capability. I think that's the source of value where we can go for clients and configure a particular application or a particular platform to their needs ourselves because we understand it well. So I think that part we want to keep in-house as much as is required in that specific to the use case. On digital migration, I think it's a fair observation that if there are better ways of doing it and we take it to existing clients, there will be some disruption. Typically, the thematic impact we see, take digital collection as an example, right? Our digital collection products, it does far better collections than traditional way of doing collecting, and it costs lesser, right? So it invariably means that our revenue is lower with digital collection deals, right? And if we are converting, yes, we'll lose some revenue. That does not happen as that often, but if there was a direct conversion, we'll lose revenue. But we'll gain far more profitable revenue, right? That's the whole idea of an IP-based solution that is more profitable. And I think it's a valid trade-off to be done because the market is kind of headed there, right? Market wants those new generation solutions, and I'm very open to kind of pursuing those solutions to give a better or a next generation way of doing things to our clients, even if it means there is some element of short-term or temporary revenue compression because of that. So overall, at this point in time, we haven't seen decline because of that. I think the idea is because these markets are vast, if we take this thing, I see them as an opportunity to gain market share of profitable revenue and not necessarily impacted on revenue thus far. Those are the two responses. Did I answer all three questions? There was another one.
Just for the first one, what kind of uptick you have budgeted for your digital outlay, and will there be a short-term impact on the margins as you transform your more and more business to a digital side?
So we haven't quantified systematically, we've been investing in platform teams for every idea within every BU to say if this is a specific platform idea we want to chase, build a team around it. Those investments are baked into the, what we saw in YTD thus far, and it's baked into the forecast for the future. I don't expect this to be a meaningful call out to kind of impact the margin, but it'll be a continued investment, but not necessarily that it causes a downdraft into the margin.
Right. Thanks for taking my question and wish you good luck.
Thank you.
Thank you very much. Next question is from the line of Madhu Babu from Canara HSBC. Please go ahead.
Hi sir. Congrats on a good quarter. Sir, any discussions on a new blend model, where, you'll have a mix of work from home and office, and how is that going to impact the pricing in the sector? Especially in BPO, obviously not everything can be done from, home and all that. So just your views on any potential changes in the delivery model over the next 1.5 years.
Yeah. Hi, Madhu. Thanks for your wishes. This is a topic amongst a few clients, and some of our big clients are testing out different models of, if I was to do a blended work from home, is it one person goes to work 1 week, another person comes in next week, or 2 days a week and then 2 days someone else? Or is it a percentage of people who are permanently hired to work from office and a percentage of people permanently hired to work from home? A couple of our clients are testing these two models at some level of pilots to see what the impact on performance and employee engagement is. So I think we'll see how this evolves. It hasn't reached a stage where people are saying, hey, I need a discount or the other, because we know that, there'll be some trade-off one way or the other, right? For instance, we've seen that wherever we do more work from home, while there might be some savings on the facilities cost, there is a higher leadership and engagement cost, because when somebody is remote, you have to spend that much more effort to engage with them, to train them, right? And sort of do all the stuff that you need to do to make sure the culture remains intact. So there is a put and take on the cost side of it. But we have reached a stage with clients to start to quantify in terms of discounts or premiums. My sense is that over the next 2 years, it will reach a stage where it will change from what we have done historically. Whether that changes to 33% of the population or 40% or 50%, we will see. And it might vary from industry to industry as well in terms of banking behavior versus bond digital behavior, right? So a lot of it will depend on sort of how regulated the industry is. But thematically, I do expect this to change for BPO, at least to the range of sort of 20 to 30% capacity starting to work from home once life returns to full normal.
So would it be like...
Sorry to interrupt, Mr. Babu. Before you proceed to your next question, we are observing a slight background noise from your line, sir. So maybe we could request you to please come in a noise-free area, sir.
Yeah, 1 minute. Second, sir, on the capex, the 109 crore of capex for the 9 months, how much of it is for the licenses? Because we have some license purchases every year in the capex.
Dinesh, you have that answer?
So in the meantime, probably I can take that, Madhu. So on the capex, again, whatever you're seeing right now is predominantly to drive for growth, get the equipment, get the some of the offices built out, and mostly on the equipment, the IT equipment part of it. There will be some element of licenses, but again, from the way our business is structured, licenses is not really the biggest element of capex that goes out.
Okay. Yeah, because I remember last year or year before, licenses was a significant part. And just last one on the top account, obviously, sir, how we see the disruption, how it is going to, any next year, can that be again a risk in terms of the overall growth or a decline in that account? Can you give your views? Because OTT is a big disruption happening in the sector. Thanks.
Sorry, so Madhu, are you saying that do the client's business mix, we see their business mix changing?
Yeah, any impact on the client and on obviously from that to your business?
Yeah. Look, they have a very strong OTT offering in the markets that they operate in. We serve them primarily for the UK market. And we have as much a market share of servicing their OTT as much as their core, triple play product that they have. The UK market has, so they're moving with sort of the change in the mixes, right? But the UK market hasn't shown any major movement from what it was earlier, except people are consuming more. But OTT is a very big focus area for us. We are very focused to make sure that whatever the key drivers of that market are, which are primarily customer retention and moving customers wherever the product is, like you look at Peacock in the US. Peacock is a free product and a $5 a month product and a $10 a month product. That people move up from the free to the 5 and the 5 to the 10. So we are working hard to develop our capabilities and offerings such that we can address this primary need for the OTT segment. But I see this market has a lot of growth potential from the traditional way of doing things, and we hope that we can play a meaningful part in this market, the OTT evolution that's going on around the world.
Okay, sir. Thanks.
Thank you very much. The next question is from the line of Sachin Kasera from Swan Investments. Please go ahead.
Yeah, congratulations, people. Nice to see that growth has started to come back at FSL after a long period of time. So that's very happening. Congrats on that. I had just two quick questions. One was regarding the capital allocation policy. Now that one of the prime area of focus is growth, and secondly, now that the debt is down, how are you going to look in terms of allocating the cash flow going ahead in terms of payout to shareholders as well as using it for growth capex?
Yeah. Thanks, Sachin. Look, so capital allocation, right? From the free cash flow that we generate, three avenues are organic investments, inorganic investments, and return to shareholders through dividend, right? These are the three primary things.
Yeah.
Besides our organic capex needs, right? Centers, equipment, etc. I think the strategy that I've been articulating and is starting to take root is that we have to, if we want to pursue industry-leading growth, top quartile growth, we need to continue to invest in adjacent areas of growth and continue to gain market share in the segments that we operate. So there will be some element of continued organic investment in things like capability building, sales capacity, solution capacity, etc., even delivery leadership, etc., right? And that will sort of continue at some level. Inorganic, we want to be disciplined, we want to be systematic on saying what are our priority growth areas, right? So provider is one area of growth where we think a lot of disruption in the market, a lot of potential, and we need to continue to buy pockets of expertise to expand our footprint in that market. Likewise, for collections, we see opportunities to grow in the US as well as in adjacent markets, right, to that. So there are some priority areas for inorganic that we are focusing on. Again, nothing specific to the report. And now, Ankur, remind me, this was our third or the fourth dividend payout now?
This is the fourth.
Fourth. So Sachin, we are falling into sort of a reasonable pattern of return to shareholders. And this was the fourth payout since the company returned into good financial health. And I expect this sort of allocation between organic, inorganic, and return to shareholders will continue as part of the framework of a capital allocation policy.
Sure.
As specific I can get at this stage.
Sure, good. Second question was, it's been now a while you have spent time at FSL. Can you give us not a guidance, but sort of a vision here? How do you want to take the company, say, 3 years from now? Where do you want FSL to be?
That's a long answer. Just summarizing the points. Choose our battlegrounds carefully. For now, a lot of segments in BFS that we think we can expand into. Healthcare, right? We play in both the provider and the payer space as well as the health services. We see growth segments. And then CMT, especially with focus on media and tech. In all three, the vision is that choose the battlegrounds carefully and either have the leadership position or aim for leadership position, right? All this totaling up, as I've been saying, should mean top quartile growth for the BPO segment. And this cannot come unless it's powered by digital, right? Whether it's digital services automation and business IT, or BPaaS, business process as a service, right? So digital will form an increasing part of either our custom solutions or BPaaS. And yeah, the vision would be to be a company which is, attracts top talent because we grow and we do contemporary solutions, and because the culture is such which allows empowerment, engagement to people and allows them to grow. So I think that will be the biggest destiny, that if we continue to attract top talent, that in itself will feed our growth. And we'd like to be counted in the chosen segments. That's kind of pretty mundane description of the vision.
No, that's very helpful. That's all. One bookkeeping question is net debt of 200 crores. This is after adjusting for the customer advances, right? So if not for that, the net debt would have been a little higher.
That's right.
Okay.
That's right.
Thank you.
Thank you very much. Our next question is from the line of Anirudh Thakre, an individual investor. Please go ahead.
Yeah. Good morning, and congratulations for very good results. Actually, my query is, what is the next sector?
Mr. Thakre, but your voice is slightly feeble. May I request you
Yeah,
to
can you hear me now?
Yes, much better, sir. Thank you.
Yeah. Good morning, and congratulations for good results. I just want to know, what is the next sector which you feel that will grow in coming quarters, and how much it will grow and why it will grow? And other second question is do you see any big opportunity in India after this new budget?
Sure. Thanks, Anirudh. Presumably your questions are more when you talked about sectors for growth, you're talking in the context of Firstsource, right? On where we play and where we want to play.
Right.
Yeah. Okay. Yeah. So as I have said before, BFS is performing strongly, and I think it will continue to perform strongly. Healthcare is the one where we see increased growth rates than what we've seen as we go into the next year. CMT also saw strong growth, but we play mostly in the C segment, right, the communication segment. But
right.
Media and tech are the growth segments where we expect to start to see some wins next year and meaningful revenue start to come in maybe end of the year, next fiscal. That's how I think the growth waves will pan out, overlapping growth waves of BFS, healthcare, and CMT, right? To kind of provide the sustained growth that we want. For India, we do few marquee clients, which are strong historical relationships that we've done. We're starting to look at India because of the rise of telehealth. We see opportunities for telehealth and remote patient monitoring. So that is something that we are exploring with a couple of leading sort of hospital service providers for the India market. And again, the intention is not to do big things, but kind of do targeted things which allow for newer operating models to develop for the India market, and then we can leverage that for the broader core US and UK markets. That will be the strategy behind choosing targeted Indian client base to build some new operating models and then take it out.
Right. Just to add on to my earlier question, as far as this COVID situation, we can see some recovery in US and UK business. But pertaining to health services, now probably you may have better opportunities upcoming in coming time because of this improvement in the situation compared to other segments.
For sure. Of course, right? So as we've been saying that a lot of elective procedures have been deferred by patients in the US, right? Because they don't want to go to the hospital unless it's a true emergency, right?
Right.
And people have been advised not to as well to save and conserve hospital capacity where the counties and states have been more severely impacted. So as life begins to come back to normal, elective procedures, diagnostic procedures which have taken a back seat, they will come back to the fore, and we'll see increased volumes into our hospitals, which then has a ripple effect on our different models, whether it's the claim volume for a health payer business or it's for the eligibility services and payment business of our providers. So as life begins to normal, I think healthcare will see volumes return, plus the gains from new emerging opportunities like the telehealth, which has taken off really well, I guess across the world, not just in US or UK.
Yeah. Just want to understand, like, you know the situation over there very well. So in which quarter do you feel that this will come up on normalcy rate or something like that? Can you give me any insight on that? Like, is it possible?
I'm sorry, I didn't follow. What?
See, now this corona vaccine jabs are available in the market. So in UK and US, most of them are getting it on priority basis. So I just want to know, like, the situation over there, wherein you can understand that okay, for next few quarters or second quarter in upcoming financial year, you can have this particular normalcy for this healthcare sector. So. Can you get the point?
No, I'm trying to follow.
My query is like, till which quarter you feel that you can get a good amount of business from this healthcare sector? Like, when we can expect a good result from it?
The recovery will be provided.
Yeah, knowing these jabs and all the injections in the market available. So.
Yeah, we'll see sort of how quickly the vaccination picks up in the U.S. Right now, we've been doing about 1.3 to 1.4 million people a day. Our new president has said by summer, so by June or July, we should have majority sort of inoculated. From a hospital standpoint, I think we obviously had a surge from November, December, which kind of went back a little bit, right? The volumes went back a little bit. Otherwise, we were starting to see September, October, the level of normalcy. My sense is that if we can continue the current down trajectory, right, unless this UK or the South African variant kind of takes off, hopefully not. But if this down trajectory of caseload comes down, we'll start to see normalcy revenues start to climb up for our hospital clients in March, April, and then continue to build forth in Q1, Q2, which is the Indian fiscal Q1, Q2. But it's still a very dynamic situation. Hard to kind of predict. Right? Things change sort of on a 2-weekly basis.
Fine. Thank you. Thank you for giving this opportunity.
Of course.
Thank you very much. As there are no further questions, I now hand the conference over to the management team for closing remarks. Over to you.
Right. Well, first of all, thank you everyone for giving us an hour and 15 minutes of your time and your interest. Truly enjoyed your questions and your continued engagement with the health and sort of opportunities for our business. We hope to continue to engage with you and look forward to seeing you and talking to you next quarter.
Thank you very much. Ladies and gentlemen, on behalf of Firstsource Solutions, that concludes today's conference call. Thank you all for joining us, and you may now disconnect your lines.
Playback is complete.